My dad retires next year and is in a money market fund. Can you explain that a little, and could that benefit him going into the second half of the year? So much uncertainty, in market direction. Jess, again, I have to preface this. By telling you that I'm not a licensed financial advisor, and I suggest that everybody consults a licensed financial professional and a retirement professional for their own individual needs. Okay. Money market funds. So if I was talking to my father, and that's kind of how I'll answer questions when I talk about these kind of things. Money market funds are good, especially now because of the where interest rates actually are. Okay. It's a safer place where they can hide out instead of being in, something like Adobe or Nvidia or Tesla and have extreme volatility in their portfolio. A money market fund it's a mutual fund. It's a type of a mutual fund. And it's going to be, mutual funds will give you much lower exposure and much lower volatility and much lower risk than if you were holding on to individual stocks themselves. So money market funds are considered much lower risk. And when you are retired, usually you want to lean towards a much lower level of risk compared to when you're younger. When you're younger, you can take risk. You can wait out a 50% drawdown. Like you take a look at Nvidia last year. Nvidia last year was down, 60, 65%. But if your father's retired, or if he is retired or is getting ready to retire, yes, Nvidia has now recovered very quickly. But in the event of a market downturn, let's say you have a market downturn, let's say you do have a recession, and it takes 2 to 3 years for the market to go back to its all-time high. When you're retired, you need that money. You don't have the luxury of waiting 2 to 3 years for markets to recover. Now, when you're in your 30s or in your 20s, you don't really care that the market went down this year or next year, because in 5, 10, 15, 20, 25, 30 years, when you're retired, the market's going to be significantly higher than where it is in your present day. So time horizon really, really matters when you're trying to figure out what to do with your long-term portfolio stuff. But again, I would suggest your father talks to a retirement professional that can look at his entire financial situation to determine what are the best investments and the investment vehicles for him. There's a lot of different, like you can go and you can buy short-term US T-bills right now and earn over 5% on your money over the course of a year. So your father can get over 5% on his money risk-free by going into T-bills, right? There's a lot of different things available today with lower risk that were not available over the last 10 years. Over the last 10 years, you have to go back to 2007, 2006 to get interest rates where they are now, where you can actually earn 4 to 5% on your money by giving it to the government. When you're getting a T-bill, you get a 3-month or a 6-month or 1-year T-bill, or you're going and you're buying treasuries. They used to pay such a ridiculously low interest rate that it was a joke. You'd have to have so much money in order for it to even be worth it. But now you're talking about 5%. And if you're retired, when inflation is under 5% and you're earning 5% with zero risk, what's the risk? The risk is the government's not gonna pay its debt. I know you have the debt ceiling issue, but the U.S. will always pay its debt. It's one of the lowest risk investments that you can possibly make, and you can earn 5% on your money. You go back 4 years ago, it was 1%. It was 0.8%. Now you can get 5%. So there's a lot of different options available for lower risk appetites than there were years ago. And I think it's very important your father talks to somebody about all the options that they have.